Welcome back. You're still watching Smart Money on CNBC-TV18. I have with me Rupal Bhansali, who's the Chief Investment Officer, Global Equities at Ariel Investments. She manages an AUM of over $7 billion, and she's part of our Outstanding Women in Finance series. Rupal, apart from everything else, has also written a book called Non-Consensus Investing. So we're going to talk a little bit about that. Rupal, you know, in one of your chapters, you talk about how sizzle fizzles and patience prospers. So that's basically the importance of being a patient long-term investor. In a world full of short-termism, why is it important to be a long-term investor? And more importantly, does it still work? Because, you know, trends are changing by the hour. Forget about by the year. Does it still work to be a long-term investor?
Actually, companies that have a lasting quality and a lasting value proposition for their customers tend to be multi-baggers, compounders. And the companies that in the short run, you know, seem like they're very successful, but they don't really have strong foundations and actually are exposed to a lot of risk, they can actually fizzle out as quickly as they sizzled. I mean, just look at Facebook, Meta, which is a stock now, it is down about 75%. You know, back then, everybody talked about what can go right in that company. It had a 6 billion people customer base, right? Nothing gets better than that kind of addressable market opportunity. And it was practically a monopoly in what it did. Yeah. And even so, even a successful company like that can fail. So I think there's a lot of, when people get carried away with all the things that can go right about a company, they forget to think about what can go wrong with the company. And the thing that happened with Facebook or Meta is that their business model depended upon advertising. And advertising is actually quite cyclical, and advertising is quite a commodity in that the demand for advertising, the supply of advertising determines advertising pricing. So what happened is that TikTok came along. Nobody saw TikTok coming along. And that really changed the whole supply-demand dynamics. Now, Netflix in the US is facing so much competition that they have decided to introduce advertising-based business model. Yeah. So again, more supply of advertising inventory. Amazon came up with advertising inventory. So what you find is that people did not do their homework correctly. And you know, anything that looks very attractive and is successful today, people fail to ask the question, will it be successful tomorrow? So that is what I mean by sizzle, fizzle, but patience prospers. Okay. Now, a lot of people equate speed with quality. You know, express delivery, overnight delivery, high-speed internet, everything that has speed, people think that means it's great quality. But in investing, it's the opposite. Because investing is not a sprint, it's a marathon. In fact, anybody who wins the first lap is almost sure not to finish the marathon, let alone win it. You know, it's the opposite. You have to pace yourself, you don't race yourself. So I think this is why I wrote that chapter, because a lot of things about investing are very different than what you think about in life.
And I think patience and consistency are the most underrated tools to become a successful investor, right?
It's the free lunch in markets. Think about it. You can be the best trader of a seed. But if you let the seed become a flower, even if you're not a great trader, you will make way more money.
Absolutely.
And that is the power of patience. It's not the slow move, it's a smart move.
Okay. And why should people read your book? I'm asking because there are so many investment books out there. It's almost cluttered, right? The space. Yes. So how is your book different from others?
Well, it's a question I asked myself before I wrote the book, because I didn't want to be another one of those, you know, investment books out there, which just repeat what has been said before. So a couple of reasons to read the book. One, a lot of books, you know, offer platitudes. Buy high, buy low, sell high. I mean, sure, I would love to do that, but show me how to do it. A lot of people say, you know, buy quality companies, but again, they don't tell you the how. They leave out the craft. They only tell you about the end game. So I describe the craft of doing that research. I describe how I came about my investment ideas, which ones I rejected, which ones worked out and why, which ones didn't work out. So in a sense, it's a journey of learning. Unless you're able to work with great investors, you know, and I was very fortunate. I worked with Soros, I worked with some great investors. I learned from them. But not everybody gets a chance to learn at the feet of the masters. So if you can't, then there's a proxy way to learn, which is read a book like this, because it's written from a practitioner's perspective, not as a professor.
Okay.
So I think those are the kinds of things that you get from this book. Which is real-life examples in the contemporary stock market world.
Okay, folks, go buy the book, read it. There are some big life lessons and investment lessons, right, in the book. What is the biggest mistake you think people make in investing?
So people think that investing is about picking the hot dot and the hot stock. It's about picking the winners. Actually, it's about avoiding the losers. If you think about it, if you start with 1,000 rupees, let's call it 100 rupees, and you lose 50%. Now you're at 50 rupees. Everybody thinks I've lost 50%, I need to make 50% to get back to my... No, if you make 50% from 50 rupees, you're only at 75 rupees. Imagine now that you only lost, first you lost 50%, so now you're having to go up 100% to get back to just where you were, right? Now, it's very hard to come up with 100% winning ideas. But let's say you have one. Let's say you have a 100% winning idea and you put that money to work, you've got back to break even. On the other hand, let's say that the idea that lost you money, instead of losing you money 50%, it only lost 20%. So now you're at 80 rupees. The same winning idea, if you put to work on 80 rupees, you have 160 rupees. Absolutely. So it's not the winning idea that makes a difference. It's the one that you lost money on that makes a difference. And a lot of people don't understand that research is not about thinking what can go right, how much the stock can go up. The first question you must ask is what can go wrong, how much can the stock go down? And you should avoid the losers first. That's the first harm of,
as they say, right? Rule number one, don't lose money. And rule number two, always follow rule number one.
Correct. But people do forget it, and so I thought it was worth reiterating.
No, of course, it's a great reminder. You know, the last chapter of your book is not on investing, but on career advice. And this show, at least this series that we're doing, is targeted towards women because it's very hard for women to survive in today's environment, especially in finance, because of, you know, how male-dominated it is, how challenging the space is. What would your advice be to women who want to follow your footsteps?
So first and foremost, it's non-consensus career advice. So I forewarn your audience, it's not the run-of-the-mill typical stuff that you hear. And if they want to read it, actually I excerpted that chapter for free. It's on my LinkedIn post and it's also on my website, nonconsensusinvesting.com. So you can just read it. But the essential elements of the advice that I have for women is, money is a taboo topic amongst women. They don't think about it. They don't know how to invest their money. They're very daunted by it. And I'm a big believer, if you know how to cook, you can manage your money. Managing money or understanding money is not that difficult. It just, you have to get started. And just like cooking, you don't learn all cooking day one. And you learn cooking only by doing it. So I would encourage all women to earn money, because when you earn money, you learn money. Once you learn money, you will manage money. And once you manage money, I hope you will learn to multiply money. After reading this book, Non-Consensus Investing, it'll tell you at least the basics of, how to get started. But in terms of non-consensus career advice, a couple of things I would tell women. One is raise your hand, even if you feel you're not qualified for that job or that role or whatever the opportunity is ahead of you. A lot of times women feel that they need to be qualified before they will take on a responsibility. Men, on the other hand, have no such compunctions. They could completely muck up a job, but they will still take it on. And they will muck it up, but the advantage is they will learn from those mistakes. And the next time they do something similar, they will make fewer mistakes. So experience and expertise is built on the shoulders of mistakes. So my non-consensus career advice for women is make more mistakes. Put yourself out there.
Well, that is something that everyone should know, man or woman, right?
Yes.
You need to make mistakes.
Absolutely.
And that's the
Put
only way you
yourself
move
out there.
forward. So what is it? Earn money, learn money, manage money, and then multiply your money. All right. Well, on that note, thanks a lot, Rupal, for joining in. It was a pleasure speaking to you. And since this is our show where we talk about, financial literacy, every week we give our viewers one financial tip of the week. So I'm going to just take it straight to that. If you, our viewer, looking to do passive investing, then here are some top performing index funds that we put together for you across large, mid and small caps that perhaps have given the best returns in the last 3 years. Now, these are index funds all above 100 crore AUM, because that's the way you should focus. The first is the Nifty Next 50 Nippon India Nifty Next 50 Junior. You have the UTI Nifty Next 50 Index Fund. There's the DSP Nifty Next 50 Index Fund and ICICI Pru Nifty Next 50 Index Fund. So that's the list there of the top performing large cap index funds. All of these funds have in the last 3 years given you a return of anywhere between 15 to 16%. But the juice is really in the broader market. So let's move to the mid cap index funds. The two top performing funds are Motilal Oswal Nifty Mid Cap 150 Index Fund and the Nippon India ETF Nifty Mid Cap Fund. These two funds have on an average, of course, benchmarked the mid cap cap index and given you a return of 25% in the last 3 years. Let's move on now to the small cap index funds. One of the best performing ones has been Motilal Oswal Nifty Small Cap 250 Index Funds, which has seen a 27% return in the last 3 years. All this data has been very helpfully put together by Moneyfront, so thanks to them. And on that note, thank you for watching Smart Money. Keep writing to us and giving us all the feedback. We love hearing from you. Till we meet again, thanks a lot.